For decades, corporations signed multi-million-dollar leases for real estate and heavy equipment, yet accounting rules allowed these massive operational liabilities to vanish from the balance sheet. They achieved this by classifying them as operating leases. MFRS 16 was deployed to close this multi-trillion-dollar reporting gap by requiring entities to recognize these obligations on the Statement of Financial Position. Under this standard, a lease is defined by the right to control an asset, regardless of the contract's legal title. The first mandatory test for control is the existence of an identified asset. The asset must be explicitly or implicitly specified in the contract when it is made available for use. If a customer rents a truck's cargo capacity, but the supplier retains all operational direction over the vehicle and its routes, the customer is purchasing a service. There is no lease because the customer lacks control. Identifying a physical asset is only the first hurdle. True control requires proving that the supplier cannot pull a bait-and-switch behind the scenes. This introduces the concept of substantive substitution rights. If a supplier possesses the power to swap the identified asset for an alternative at any time without the customer's approval, the customer does not truly control it, which nullifies the lease. For a substitution right to be considered substantive, two precise conditions must be met. The supplier must have the practical ability to swap the asset, and they must derive an economic benefit from executing that swap. There is a strict exception to this rule. If the contract only permits substitution during trigger events, such as mechanical breakdowns or scheduled maintenance, the substitution right is not substantive, and the lease remains intact. The second pillar of control requires that the customer obtains substantially all economic benefits from the asset's use. Furthermore, the customer must possess the absolute right to direct how and for what purpose that asset is used throughout the contract period. Real-world contracts frequently complicate this by bundling components. A single agreement often combines a lease component, like the use of a truck, with a non-lease service component, like routine maintenance and repairs. MFRS 16 mandates that lessees allocate the total contract consideration between these distinct elements. They do this by calculating the relative standalone prices of each separate component, as if they were purchased individually. By requiring this separation, the accounting standard removes the shielding of bundled services. It isolates the underlying financial commitment attached to the physical asset itself for accurate reporting. Under this framework, lessees no longer classify leases as operating or finance. With very few exceptions, virtually all leases must now be capitalized. At the commencement date of the contract, the lessee executes a specific initial recognition journal entry. They must debit a right-of-use asset, or ROU asset, and credit a corresponding lease liability. The initial measurement of the lease liability is calculated as the present value of all unpaid future lease payments. Present value is a financial calculation that determines the current worth of a future sum of money. To find this present value, these future payments must be discounted. Lessees must use the interest rate implicit in the lease, or if unavailable, their incremental borrowing rate. This is the rate a lessee would pay to borrow funds over a similar term. As time passes, the subsequent measurement phase begins. The right-of-use asset is systematically depreciated over the lease term, while the lease liability is gradually amortized as payments are made. This table shows the relationship between the two accounts over an 8-year term. You can observe the depreciating asset and the amortizing liability dropping in parallel over the lifespan of the contract. This amortization follows the effective interest method. It maintains a constant periodic rate of return on the remaining balance, inherently front-loading the interest expense in the early years. This front-loaded expense curve alters a company's reported profit profile. Because interest is highest when the principal is untouched, earnings appear lower in the early years of the contract, compared to the older accounting model of recognizing flat rental expenses. Although MFRS 16 established a single accounting model for lessees, lessors continue to use the historical dual classification model. Lessors must apply a defining test. Does the lease transfer substantially all risks and rewards incidental to ownership of the underlying asset to the customer? This schedule illustrates the finance lease. The lessor derecognizes the physical asset from their books and replaces it with a lease receivable, which represents their net investment, systematically reduced by incoming lease payments. If the risks and rewards do not transfer, it is an operating lease. Here, the lessor keeps the physical asset on their own balance sheet, continues to depreciate it, and records the incoming rental payments as income on a straight-line basis. When an operating lease is formed, MFRS 16 creates an accounting paradox. For the exact same piece of equipment, the lessee records a right-of-use asset, and the lessor retains the property, plant, and equipment asset. Both parties hold an asset for the same physical item. This asymmetry demonstrates that MFRS 16 focuses entirely on mapping the distribution of economic rights, rather than tracking physical ownership. This focus on economic rights governs the sale and leaseback transaction. In this scenario, an entity sells its own asset to a buyer and then immediately signs a contract to lease that exact same asset back. Corporations utilize this maneuver to instantly unlock capital from their real estate while maintaining uninterrupted operational use of the facility. MFRS 16 dictates that the accounting treatment hinges entirely on whether the initial transfer qualifies as a sale under MFRS 15, Revenue from Contracts with Customers. MFRS 15 is the standard that governs when control of goods officially transfers to a buyer. If the MFRS 15 criteria are met, it is a true sale. The seller-lessee must measure their newly leased right-of-use asset strictly as the proportion of the previous carrying amount that relates to the rights they are retaining. Because of this proportional rule, the seller is only permitted to recognize a financial gain or loss related to the rights they actually transferred away to the buyer. This mathematical constraint prevents companies from artificially inflating their profits. If control of the asset does not legally pass to the buyer under MFRS 15, it results in a failed sale. A failed sale is treated strictly as a financing arrangement. The seller must keep the physical asset on their books and recognize the cash they received from the buyer as a standard financial liability. It is recorded as a loan. To complete this transparency, strict disclosure requirements apply. Lessees must reveal their interest and depreciation expenses, while lessors must detail their residual value risk and finance income. By forcing the right of use onto the balance sheet and strictly policing sale-leaseback maneuvers, MFRS 16 exposes the exact economic commitments of a business. It places total operational liabilities in plain view for global capital markets.